I want to talk about the problem of asymmetric information in financial markets. Specifically, I want to talk about one form of asymmetric information referred to as adverse selection. In your typical introductory finance course, we usually assume a world of symmetric information. That is, all of the parties have the same information, might be a lot, might be a little, but everybody knows the same information. Now, in real life, this isn't the case, and we refer to this as asymmetric information. One party knows more than another party. Now, the reason that we have an asymmetric information problem is because information is costly to obtain. For example, if I'm a smoker and I'm applying for a health insurance policy or a life insurance policy, I know that I'm a smoker. But my insurance company doesn't actually know that I'm a smoker. I can check the block that says non-smoker, and it's costly for them to figure out that I am a smoker. How would they do that? Well, they could send somebody to follow me around for an entire day to see if I smoked a cigarette. It's possible that they might have me get a physical, in which case I'd get a chest x-ray, and it's possible that, depending on how much I smoke, the physician might be able to determine if I have some buildup in my lungs that I'm likely to be a smoker. But these are costly transactions. So so I know that I'm a smoker, but they don't, and that could be a problem for them. So adverse selection occurs when one party in a transaction has better information than the other party, and it occurs before the transaction occurs. So before I buy that life insurance policy, before you sell me your car, there's information that someone knows that the other person doesn't know. And the problem with this, for example, in the case of financial markets, someone borrowing money, potential borrowers are most likely to produce adverse outcomes are the ones most likely to seek the loan. Those that know that they're not likely to pay back, those that know they're not responsible, or that they don't have sufficient funds or sufficient income. This is part of the reason we had this financial crisis in 2008, that people told the banks that they would pay back the loans. They told them they had plenty of income, but the banks didn't investigate further because it was costly to do so, or the loan officer didn't, and was under pressure to write a lot of loans, and so they wrote loans and mortgages to people who were very bad credit risks. Now, an analysis of asymmetric information problems and their effect on behavior is sometimes known as the agency theory or the agency problem. And the agency problem is the idea that a principal, someone who needs something done, instead of doing it themselves, they hire an agent to do it for them. And you can think of an agent as the agent for a professional athlete or for a celebrity. They hire someone to negotiate the contract for them. You may hire a real estate broker to sell your house for you. You could do it yourself, but you hire this person as your agent to try and get the best price for you, etc. You may hire someone to manage your store for you. You could manage it yourself, but you've chosen to hire someone else to manage it for you. That's an agent. The problem with this is that the agent doesn't always have the same goals that the manager or that the principal has. And so concepts such as adverse selection and moral hazard, which I'll discuss in another video, can be a problem in the financial markets. Hey, here's an example of adverse selection and how it influences financial structure. And we refer to this as the lemon problem. And the lemon problem was first brought to light by George Akerlof, who won the Nobel Prize in Economics in large part because of his work on the lemon problem or asymmetric information. Now, today we think this is an important issue, but when he originally tried to publish the paper on this, it was not widely regarded. People weren't interested in the topic, and he had a hard time publishing it. Now, oftentimes, Nobel Prize winning work are by people who are ahead of everyone else thinking clearly, and people don't understand what they're doing, or they don't understand the mathematics of it. And oftentimes it's not that easy to get people to side with you. Anyhow, the lemon problem is the idea that we can't distinguish between good and bad, okay, bad being lemons, for example, in the used car market. So if that's the case, a person trying to buy a car is only going to be willing to pay the average of good and bad car values, okay? Because they don't want to pay for a good car and get a bad, get a lemon. So they're not willing to pay the person who has a good car that's well kept a fair price for it. So what happens? Good cars oftentimes won't be sold. I'm not going to sell the car. My car is in terrific shape. Person's offering me a lot less for it because other used cars are not in such good shape, and this person has a hard time identifying whether my car is a cream puff or whether it's going to be a real problem. So the used car market doesn't function efficiently. Okay, how can we avoid this problem with used cars? Well, you may have seen commercials for Carfax. Carfax is a company that gathers information on cars. If a car's in an accident, it has to be reported, or it's supposed to be reported, and Carfax has that information. And you've maybe seen the commercials of two people standing in front of a driveway, and the seller says that it's, I want $12,000 for my car, and the person says, oh, well, Carfax says it was in an accident, okay, or it has flood damage, and the person keeps lowering the price, and they go, oh, it was just a scratch. Well, Carfax says it was totaled. And that's one way of dealing with it. I gathered some information. Another is to take the car to be inspected by an independent mechanic. Okay? If you buy a used car, if you're going to spend $12,000, it may be worth spending $100 to take it to your local mechanic and have that person look over the car, make sure nothing's leaking, make sure the engine is good, the transmission, the belts, the hoses, everything are in good working order before you pay for the car. That's a way to deal with this adverse selection problem, but you know what? It's not free. It's costly to do so. In the security markets, it might be difficult to distinguish between good and bad securities. So again, people are only willing to pay the average of good and bad securities value, which means that good securities are undervalued and firms aren't going to issue them because they have a hard time convincing the market to pay them a fair value for it. The bad securities, on the other hand, are being sold at a price that is much higher than it should be because they're getting the average of the two, and so more of these will be issued. In fact, too many of these will be issued. Investors, okay, with the same problem that we had in the car market, investors aren't going to want to buy bad securities, and so the market won't function well. Okay? And one of the keys to financial markets, or markets in general, is we like to have smoothly functioning markets. Okay? People trading at the right prices, that's really important. Okay? How can we solve this adverse selection problem? Well, there are a number of ways to do it. One is private production and sale of information. Okay? You can buy information from Carfax. If you don't know something about a bond issue, you can go to Moody's or Standard & Poor's and find out what their credit rating is. Okay? Government regulation may be invoked in order to increase information. All right? For example, annual audits of public corporations. Now, after Enron, they actually became much stricter on the public disclosure, and the CEO and the CFO have to sign off on the audited financial statements. So they're trying to reduce this adverse selection problem, this asymmetric information, by requiring more disclosure. Other ways to deal with this problem: financial intermediation. Okay. Here's the case where you let someone come between you and the lender, okay, or the borrower, and in this case, someone provides information to you. Okay, you may have the case where large firms choose to issue bonds directly to the public rather than going through a financial intermediary, because they may not get as good a loan price. Because what's going to happen? The financial intermediary may decide to give them an interest rate that's halfway between, or the average between, a good credit risk and a bad credit risk. If the firm believes that they can convince someone who's interested in buying their bonds that they're a good credit risk, then they may be able to get a better rate by simply selling directly to them. Okay, we may ask for collateral or checks on net worth. Think about mortgages. If you have collateral, if you have some money in the bank, okay, you have some net worth, you have some assets to support the loan, then you're less of a risk. Okay, sometimes you hear that phrase, the only person who can get a loan is the person who doesn't need a loan. Right? The house serves as collateral when you get a mortgage. Okay, if you have money in the bank, that serves as collateral. So, banks and financial institutions may look into this. Okay, one of the problems of the 2008, 2009 financial crisis is that, and actually it occurred before then, is a lot of these loan officers didn't check the net worth or the income of the person getting the loan. Okay, asymmetric information. I know how much I'm making, but if you don't check my employer to make sure that I'm actually earning $50,000 a year, $150,000 a year, whatever the case may be, I can say anything. And if you don't check my bank statements to make sure that I have $200,000 in the bank, even though I said I had $200,000 in the bank, okay, asymmetric information. I know something you don't know. So a lot of banks and stuff are now going back to what they used to do, checking credit reports, okay, checking your income status, checking your bank statements to make sure you actually have the money you say that you have in the bank. So that's another way to deal with the adverse selection problem, the asymmetric information problem. But again, it's not free, it's costly. And again, dealing with these problems can lead, or not dealing with these problems can lead to the financial crises, much like the one we just saw a few years ago.